It looks very much as if the malaise that's been affecting financial markets is at long last starting to recede. More IPOs, more mergers and acquisitions around the world all point to a much more robust global outlook. But anyone who thinks that this is some part of a cyclical return to the good old days is, I believe, going to be disappointed. And so today I wanted to get a really good look at the features of the new normal that is developing and how some firms are already starting to take advantage of it. The first of these is that firms simply have to find new ways to lower the overall operating cost. Such is the pressure to do this that it's causing firms to rethink how they're looking at their businesses, as well as just trying to do the same things more cheaply. A good example of this is intelligent outsourcing, which aims to replace the run your mess for less approach of before with something far more collaborative and dynamic. Its aim is to get to the ROI much earlier in the project's life cycle, and also, crucially, to enable firms to deliver their own IP, whether it's their research, their reach, their algos, directly through that outsourced layer that's doing all of the heavy lifting. That means firms get the best of both worlds, rapid innovation and lower cost. Post-trade is getting a rethink too, mainly because it's full of lots of infrastructure that's duplicated everywhere unnecessarily, and it's full of old technology based on proprietary standards. And so that's why you're starting to see free and open protocols like FIX emerge into the worlds of affirmation confirmation processing, for example. Not only is it cheaper, but it's faster and more accurate too. Perhaps the natural extension to all of this is to take all of that duplicated infrastructure and run it in the middle on a shared utility basis. Obviously that's going to require firms to put aside some of their competitive differences, but it seems to me that unless firms can find some kind of radical restructuring, it's going to be very hard for the industry as a whole to square the circle in terms of getting that operational cost to meet the economic realities of today. Another aspect to this, of course, is the relentless and onward march of regulation. The agenda today is all about taking those asset classes that are either traded over the phone or in chat rooms and bring them out onto lit markets where they're much easier to supervise. And so that's why you're going to see further increases in electronic trading and greater demands for transparency, all of which is going to fuel the need for greater workflow technology that will persist information from one part of a business through to another. But what is much less clear is exactly how all these different regulatory domains are going to overlap, especially when they opine on the same subject. A good example of this is the world of derivatives, where in the US, Dodd-Frank is mandating a bottom-up, open approach to decide which OTC contracts are traded electronically. Whereas in Europe, what we're seeing is a completely different top-down discretionary approach, but both are aiming to achieve much the same objective. As more and more of these rules start to come into force, there's going to be more gaps like this opening up. And deciding if, how, and when to exploit them is going to present some interesting challenges for market participants. The final dimension to the new normal is the very negative perception of markets generally. Now, of course, if people break the law or are just incompetent, they should be punished and feel the full consequences of their actions. But I do kind of wonder whether that's a little bit overstated. In particular, the idea that there's a separate finance economy that has somehow torpedoed the real economy. Because the truth is that finance is actually at the heart of the real economy. It's what gets bridges built, enables governments to govern, and in particular, it enables you and I to enjoy a much higher standard of living. And so if there is some kind of fundamental problem with finance, then I believe it's asking a much broader question of society as a whole. So we've just about come to the end of our spin through the new normal in financial markets. Finding a cost model that meets the new low commission, low volume world is obviously fundamentally important, and it doesn't look like the regulatory scrutiny is going to go away anytime soon either. But what I find most interesting in all of this is that firms are coming to the party either to meet a regulatory deadline or to save money. But it's the smart ones that are actually emerging with an altogether better business model. And these are the firms that I believe are going to look back on our industry in years to come and wonder how it ever worked so inefficiently.